So it's a nice time we meet for a session of consolidation. So we are going to talk about how the parent, for example, now here, I'm talking about A acquiring B, C, and D. So how the parent consolidates for the operations of the acquiring company, which it acquired. So the acquiring companies, we have said, can be a subsidiary. The acquiring company can be a joint venture, and this one can be an associate. That one can be an associate. But now for the student to know that this is a subsidiary of the parent. Remember that now this is the parent, the acquirer, the one entity which had acquired the others. So A is the parent, B can be a subsidiary, C can be a joint venture, and D can be an associate. But for you to know that this is a subsidiary, B, it must rhyme between the percentage of 51 to 100. It has to rhyme between the percentage of 51 to 100. It must rhyme between this percentage. If it's a joint venture, it must rhyme exactly at the percentage of 50. So that is the scenario whereby we can say that this is a joint venture of the parent. Then now, for it to be an associate, it has to rhyme between the percentage of 49 to 20%. So once the parent had acquired an entity between that percentage of 20 to 49, that one qualifies to be an associate to the parent, an associate to the parent. So those are mostly the relevant investing company the parent will be dealing with. You will be dealing with associates, joint ventures, and subsidiaries. Joint ventures and subsidiaries. So let me introduce with some of the notes which I think you have already, so that we can be able to understand before we go to the questions. So when we talk about this aspect of group accounting, it has a lot of standards. If you could like to do your revision, we will be talking about IFRS 3, I7, IFRS 10, IFRS 11, IS 27, IFRS 5, IS 28. So IFRS 3 is all about goodwill, how you compute for goodwill. I7 is all about cash flow. We have already done this, cash flow, preparations of cash flow statement. We have IFRS 11, the one for joint ventures, how you account for the joint ventures, the joint arrangements. We have IS 27, which says that when the parent has a subsidiary, it has to prepare consolidated financial statements and present those statements during the AGM to the shareholders. IFRS 5 talks about discontinued operation, whereby you could find that a subsidiary had been disposed. IS 28 talks about accounting for the associate, so using the equity method. The same with joint ventures. Remember that even if I have talked about joint arrangements being IS 11, when I will be accounting for joint arrangements, I would be using equity method, which will be used in the accounting for associates, which is under International Accounting Standards 28. So when we talk about group accounting or consolidation or business combination, we always say that business consolidation is bringing together of two or more companies into one entity. So you bring two or more companies into one entity. Like now on the whiteboard, I have said this parent A will have to consolidate the operations of B, C, and D so that it presents one financial statement. Because initially in your exam, at the start of your exam, you will be given statements at the start of your consolidation question, to be more specific in your exam. You will be given the statements of A. If it's an income statement, you will be given an income statement of A, B, C, and D. The same with statement of financial position. So the parent will be required to consolidate the operations of that B, C, and D so that it presents one financial statement. They look as if they were one. So that they look as if they were one entity. They look as if they were one entity. So that is why you can see here they are saying that a business combination is bringing together two or more companies into one entity. The main objective of preparing group accounts is to present financial statements of the parent company and its investee companies as if they belong under one economic entity. That is the example I have provided. And now the terminologies like parent. So these are about the entity that controls one or more other entities. Like now A controlling B, C, and D. From the example I just interpreted on the whiteboard. So it's the entity which obtains the controlling interest in other entities. That is correct. So the next terminology is all about subsidiary. Subsidiary, I've said, is all about an entity that is controlled by the parent, in which the parent owns more than 50%, which is 51 to 100%. For the group, the word group means the parent company and all its subsidiary companies, the parent company and all its subsidiary companies. Then we have control. So control is all about the power. When you control someone, you have the power to govern him. You have the power. The president has the power in this country. But now the consolidation, we say that refers to the power to govern the financial and operating policies of an entity. That means that you have control. And the parent has control in subsidiaries, but not in associate or joint ventures. Because in the subsidiary is where he has a percentage of more than 50, which is 51 to 100, which is 51 to 100%, which is 51 to 100%. So refers to the power to govern the financial and operating policies of an entity. The financial and operating policies of an entity. So the parent has that opportunity when he has a control in the subsidiary. So he can govern the financial and operating policies of that subsidiary. Because I have said, for a subsidiary to be called a subsidiary of the parent must have acquired it between the percentage of 51 to 100. So, and that is the control. But in associates or joint venture, remember associates, it will be between the percentage of 20 to 49, and joint venture exactly at 50%. So in those associates or joint ventures, the parent doesn't have control, but it has something we call significant influence, of which I will be looking right on the indicators of significant influence. I will be looking at the indicators of significant influence. So the indicators of significant influence will be looked at later. So let's continue. So when we talk about the control, we have talked about the power to govern the financial and operating policies of an entity. So which I've said the parent has control in the subsidiaries, but he has significant influence in associates and joint ventures. Then, as per IS 27, as per International Accounting Standards 27, the parent company is the control is presumed to exist when the investor owns more than 1/2 of the voting power in the investing company. So that is what I have said, that right now in the subsidiary, you will be owning more than 1/2. 1/2 means more than 50. That is 51 and above. That is 51 and above. So however, there are circumstances whereby the control exists, even if the parent company owns exactly 50% or less. So even if we have been talking about for control to exist, there must be control, there must be acquisition of a percentage of 51 to 100. But now here, we are saying that again, control can exist even if the parent company controls exactly 50% or less of the voting power. So these circumstances are this one. Number one, the investor has power over more than one half of the voting rights. So you can move during the AGM. During the AGM, he has power over more than one half of the voting rights by virtue of an agreement with other investors, by virtue of an agreement, not by virtue of control, but by virtue of an agreement with other investors. So where the parent company has power to govern the financial and operating policies of investee companies by statute of an agreement. Then where the investor has the power to appoint or remove majority of the members of the board in the investee company. So you can be able, so if he has that power to appoint or remove majority of the members of the board in the investee company. So then we talk about NCI, non-controlling interest. Non-controlling interest. So remember that right now here, when we are talking about subsidiaries. So if the parent acquired another entity, let's say up to 80%. Remember that this 80% rise between these, 51% to 100%. So which means that if this B was acquired up to 80%, B is a subsidiary of the parent. But now in B, we have a 20%, which is unacquired by the parent, which is not acquired, not acquired by the parent, which is not acquired by the parent. So which means that this percentage of 20, which was never acquired by the parent, right now in B, it's with other shareholders. It's with other shareholders. And this one, we call them minority shareholders. These ones are called minority shareholders. So minority shareholders. So they are called minority shareholders. And that is what we call the non-controlling interest. So those are the non-controlling interests. The percentage which is never acquired by the parent in the subsidiary, not in associates or joint ventures, in the subsidiary, in the subsidiary. So refers to the entity refers to the equity in the subsidiary that is not attributable to the parent company. That is, it's the shareholding attributable to minority shareholders in the subsidiary. That is what I've just explained. Like now the parent acquired 80% in subsidiary. So the 20% which is unacquired in that subsidiary, it's attributable to the minority shareholders. So that equity in the subsidiary, that is not attributable to the parent company. It's the shareholding attributable to the minority shareholders in the subsidiary. So the NCI should be recognized with their share in the statement of a financial position of the group company. So the recognition of the NCI depends on the method stroke approach applied by the group company. So it can be, so the method to determine amount attributable to the NCI. So we can use the fair value method, or we can use the partial method, the fair value method or the partial method. So I was talking about the fair value method and the fair value method. So that is the fair value method and full method or the partial method. So methods to determine amount attributable to NCI. So the fair value method is again called full method. So we say that under this method, the amount attributable to the minority shareholders is determined by taking into consideration the market share of ordinary share capital and the preference share capital into consideration. So you take both of them, the market share of ordinary share capital and the preference share capital into consideration. So for partial, under this method, the amount attributable to the NCI is determined by taking into consideration the net assets and the preference share capital, but not goodwill. But not goodwill. So for now, let's focus on now the main thing, some of the major things. Right now, goodwill is a very important item in group accounting. So when we talk about goodwill, we say that right now I would be using an example of these blue chip companies. Right now, one of the blue chip companies, Safaricom. So due to the good reputation of Safaricom, let's say we did M-Pesa with the M-Pesa of Safaricom, it always gain a lot because you would find that it has customers all over. M-Pesa, it's accessible other than in Kenya, even in other countries, Rwanda, it's accessible right now in Ethiopia. So the services of Safaricom to be general. So due to that good reputation, it has received a lot of customers. So due to the customers it has, remember that there's a return it gets. So from those customers. That is why I would go ahead and say that goodwill, it's all about a future economic benefit arising from an asset. So due to your good reputation, remember there's an economic benefit. Due to the good reputation of the business, there's an economic benefit. And which cannot be identified separately. You cannot separate goodwill. You cannot separate your good reputation from the business itself. So for consolidation, goodwill is determined by taking into consideration net assets acquired in the subsidiary and the amount paid to acquire the subsidiary. So we always say that goodwill, you take purchase consideration minus share of net assets acquired. So goodwill is equals purchase consideration. So purchase consideration is again called the cost of investment. The cost of investment. So what about share of net assets acquired? We have the preference share capital. We have the ordinary share capital. So here we can have ordinary share capital. We have the retained earnings. We have the revaluation reserve. We have the share premium, and we have the general reserve. So I can see here we have the ordinary share capital, which I was mentioning about. So these are the equity components. Net assets are equity components. So the net assets. And this purchase consideration is the amount which was paid by the parent in the acquisition or in the investment of that relevant investee company. So net assets, I have mentioned about them. Ordinary share capital, preference share capital, retained earnings, revaluation reserve, share premium, general reserve. So you have understood that what is the meaning of goodwill, which is an economic benefit arising from an asset, and you cannot be separating the two. You cannot separate the asset itself from goodwill. When you are computing for goodwill, you take purchase consideration, you minus the net assets, you minus your net assets. Then now, remember that when you are computing this goodwill, you have to use two methods. You have to use two methods. But you can't use both of them in one question. So either you can use the full method, or we call it the fair value method, or you can use the partial method. So it depends on the information you are provided. So either use the fair value method, which is the full method, or you can use the partial method. So determination of goodwill, that is why now next year you can see, I am saying that determination of goodwill depends on method applied to measure the fair value of the NCI. The method applied to measure the fair value of the NCI. So that is why I said that if the NCI is measured at its fair value, if the NCI is measured at its fair value, we use which method? Full. So that is why they say determination of goodwill depends on the method applied to measure the fair value of the NCI. So whether full method or we have the partial method. So when full method, that is the fair value method, is applied, the fair value of the goodwill is determined by taking into consideration. So when the full method, but for you to use full method, again, I can repeat now and then so that you understand. For you to use the full method, mostly the main thing we have to check was that non-controlling interest measured at its fair value. Was it measured at its fair value? So when the full method is applied, then the value of goodwill is determined by taking into consideration goodwill attributable to the parent and that one going to the NCI. So when we use the full method, the goodwill we will get, the outcome from that full method. Remember the outcome, obviously, it's goodwill. But goodwill to who and who? Goodwill to the parent company and the goodwill to the NCI. So that is when you use the full method. So the goodwill you will get is the one which is attributable to the parent and the one which is attributable to the non-controlling interest. However, for the full method to be applicable, the NCI must be stated at its fair value. That is, again, a repetition I've done. I've been mentioning about that. But that for you to use full method, the NCI, the non-controlling interest, must be measured at its fair value. Must be measured at its fair value. Must be measured at its fair value. So under the partial approach, so other than now the full, under the partial approach, goodwill arising on the acquisition is that attributable to the parent company only. Remember that when we compute goodwill using the partial method, the goodwill we will get is only attributable to the parent. Unlike the full method, we said that the goodwill will be attributable to the parent and to the non-controlling interest. And that to use the full method, the NCI, the non-controlling interest, must be stated at its fair value. What about this partial? After mentioning that, the goodwill arising is attributable to the parent. So how do you know that you are using partial? So when you are using partial, you can't find that the NCI is being recognized with its fair value. The NCI are not recognized with their share of goodwill. So in that question, you can never see any statement whereby they will say that the fair value of the NCI is this. You can't find a statement of that kind. So the NCI will not be recognized with the share of goodwill, of which first you cannot be given the fair value of the NCI. So that is why they go ahead and say normally applicable where the NCI cannot be quantified with their fair value, with their market share, or with their fair value, or with their market share. So we can do a short illustration here, whereby it says that A Limited acquired 75% of the ordinary shares of B on 1st January 2015 for 1,400. The net assets of B on this date was 1,500. On the same day, the fair value of the non-controlling interest was 400. The fair value of the non-controlling interest was 400. So on this scenario, remember that A acquired B. He acquired B 75%. For what shillings? He paid, this is like now the investment, 4 shillings, 1,400. The net assets of B, 1,500. On the same date, the fair value of the non-controlling interest was 400. So which method is applicable here? Let's say, for example, you were in an exam room, you see a statement of this kind, or you see a question, like a small question of that kind.
Full method.
So full method is applicable. So according to the illustration, if it was an exam scenario, you could have used the full method because the examiner provided the fair value of the NCI to be 400. But now I want to use the short illustration to do for both partial method and full method. So let's start from full method. So these are very small illustration. So whereby we have said that A acquired B 75%. So you acquired B 75%. So for you to use full method, remember that you must be given the fair value of the non-controlling interest. So I'm starting with full method. And we said that when you are doing full method, the outcome, that is the goodwill itself, will be attributable to the parent, and it will be attributable to the NCI. It will be attributable to the NCI. It will be attributable to the parent, and it will be attributable to the NCI. So we always start from purchase consideration. We always start from purchase consideration. So the purchase consideration is the purchase consideration. So A acquired 75% of the ordinary shares of B on 1st January 2015 for 1,400. So that one is the amount which the parent invested in the investee company. So that amount you will put it under the column of the parent. Then for it to be full method, remember that you must be given the fair value of NCI. So we have to put it under the column of the NCI. So that is when you are using full method. This is the use of full method. So the fair value of the NCI is 400. So you put it at the end there. The net asset of B, the net asset of the investee company is 1,500. So you raise share of net assets, share of net assets. So the share of net assets acquired. So I would come here and say 75% of 1,500. Then we have 25%. 25% of 1,500 goes to the NCI. So 75% of 1,500 is, and 25% of 1,500. So 75% of 1,500, that is 1,125. Then 25% of the same,
375.
So that is 375. So 375. So 1,400 minus 1,125, that is 275. Then we have 400 minus 375. That is 25. So this is goodwill. Then we can add the two, because we say now goodwill of the parent and goodwill of the NCI, we add them. So that is 275 plus 25. So this is 300. So that is what we talked about, full method. So for the full method, that is what I said. Remember that I said here, under this, so when full method is applied, the value of goodwill is determined by taking into consideration goodwill attributable to parent and that attributable to the NCI. That is why I said full method is equals to goodwill of the parent plus goodwill of the NCI. That is what I have done. Then we said for you to use the full method, the NCI must be measured at its fair value. We have considered everything on that scenario. So then for the partial method, I don't have to repeat again for partial method. The only thing you have to remove, if it's partial method, you remove this. So this one will not be there. So it will remain to be 275. So if it was just a partial method, we consider this one only. So which means that this one will not be there. The fair value of the NCI. The fair value of the NCI will not be there. So it's all about purchase consideration of 1,400. You raise the share of net assets. That is the share of net assets. You only take 75% of the net assets. 75% of the net asset. So it's only attributable to the parent. You can see it's very clear from this notes. So they said purchase consideration, 1,400, you raise share of net assets acquired, 1,500 times 75%. So you get your goodwill. But for this full method, it's what we have done. So for full method, goodwill is attributable. Goodwill is attributable to the parent and it's attributable to the NCI. So you start with purchase consideration. Then the fair value of the NCI, you put it under the NCI. Then share of net assets, you share this net assets according to the percentage which is going to the parent, which is the control. 75% goes to the parent, then 25% goes to the NCI. Then once we get the goodwill, we add it. So that is what we have done. So for full method, the first thing we have said, for you to use that full method, you must be provided with the fair value of the non-controlling interest. The fair value of the non-controlling interest. So remember that we have been saying that for you to use a full method in computation of goodwill, you must be given the fair value of the non-controlling interest. But what if the fair value of the non-controlling interest was not provided directly? What can you be provided with in order to determine the fair value of the non-controlling interest? You can be provided with this information which is given here. So they say that if the market price of ordinary shares of the subsidiary are given on acquisition date, it should be used to determine the fair value of the NCI on that date. What have I talked about? The market price of who? Ordinary shares. To which company? Of the subsidiary. Market price of ordinary shares. So which means that obvious ordinary shares, you will be told, even if it's from the balance sheet, that this is the relevant, or they will be stated in the balance sheet. If they will not be provided elsewhere, ordinary shares, they will be given in the balance sheet. The ordinary share capital, to be specific. So you must be provided with the market price of ordinary shares of the subsidiary. So if you are provided that, you can determine the fair value of the NCI. How can you determine that? In this case, the fair value of the NCI is determined by multiplying market price. So you take that market price of the ordinary shares with the number of ordinary shares, not the ordinary share capital, the number of ordinary shares attributable to the NCI. Let us look at an example there. Let us look at an illustration which has this information, which has a market price of the ordinary shares of the subsidiary. So, illustration, A Limited acquired 80% of the ordinary shares of B on 1st January 2015. A acquired B 80%, 4 shillings, 1750. When the total net assets of B, remember that I said net assets, they are ordinary share capital, share premium, revaluation reserve, retained earnings, preference share capital. So, but now in these illustrations, they are just giving us a block figures. In other questions, if it's a 20 marks question, you will be given those net assets individually under the statement of financial position. So you need to know net assets. This is just block figure you are given here, but you know them. So they said 2000. On 1st January 2015, the market price, this is what we were talking about. If the market price of the ordinary shares is provided, so on 1st January, remember that this is the time of acquisition, and we said here the same way. If the market price of ordinary shares of the subsidiary are given on acquisition date, so the market price of shares of A and B, so you are given both for the parent and for the subsidiary, were 200 and 112.5 respectively. B has not B has on issue, B has on issue 20 million ordinary shares. So I say you will be given the ordinary shares of that subsidiary. So if it's not given directly in the additional information, they will be stated under the balance sheet. That is under the ordinary share capital. So you have to take the capital you divide with the price per share. That is the par value to get the number of ordinary shares. So here you are given direct. B has number of ordinary shares, 20 million that is, of which each was going at 10. But remember we said we use the number of ordinary shares, not the value. So which means that I would be using 20 and I will not multiply with 10. I can never multiply with 10, but I will use the number of ordinary shares. So calculate the value of goodwill on acquisition of B. So when you are calculating goodwill of this scenario, we will come here and say that goodwill is all about purchase consideration. So I write in initials, purchase consideration minus share of net assets. Share of net assets acquired. Share of net assets acquired. So on this case, remember that we have to use the full method. But for you to use the full method, you must be given the fair value of the NCI. That is the non-controlling interest. So the non-controlling interest, the non-controlling interest must be stated at its fair value. On this scenario, you were never given this direct, but we said if you are given the market price, if you are given the market price of ordinary shares, of the subsidiary, on acquisition date, you can use that to get the fair value of the NCI on acquisition date. So you were provided with the market price of the ordinary shares of the subsidiary on acquisition date. So the market price of the ordinary shares of the subsidiary, the market price of the ordinary shares of the subsidiary. So the market price is market price of B. Remember that is the subsidiary. So you were told that here, on 1st January 2015, the market price of ordinary shares of A and B were Kenyan shillings 112.5. So which means that the market price of the subsidiary is 112.5. So ordinary shares of that subsidiary, ordinary shares of the subsidiary. So ordinary shares, you were told that the number of ordinary shares. So B has on issue 20 million ordinary shares. So they have 20 million. So NCI percentage there is, remember that it was a 75% owned subsidiary. So B was a 75% owned subsidiary, or 80. So A acquired 80% of ordinary shares of B. So it was an 80% owned subsidiary. So which means that this is 20%. That is 20%. So for you to get the NCI fair value, the fair value of the NCI, you take 20%, you multiply with 112.5, you multiply with the number of ordinary shares. So 0.2 times 112.5 times 20. So I'm getting 450. So that is how you get the fair value of the NCI. So after getting the fair value of the NCI, we can get the goodwill. So now we can do the goodwill. So the goodwill now using full method. So goodwill goes to the parent and it goes to the NCI. So purchase consideration, the amount paid by the parent to acquire the investee companies. So the amount paid by the parent to acquire the investee companies. So the amount paid by the parent to acquire the investee companies. So that is A acquired 80% of the ordinary shares of a B for 1750. For 1750. So 1,750. 1,750. So for it to be full method, you have to be provided, or we have determined the fair value we have determined the fair value of the NCI. So I said it must be provided, or you must be given the information to aid the student in getting that 450. Then you raise share of net assets. So share of net assets acquired. So the share of net assets acquired. The share of net assets acquired. So it was an 80% owned subsidiary. So 80% of the net asset goes to the parent, 80% of the figure of the net assets. So they say that when the total net assets of B, remember that the net assets you use is the net assets of the investee company, is the net assets of the investee company. So 80% of 1750. 80% of 17, not 1750, but 2000, sorry for that. So the net asset there is 2000. 1750 was the purchase consideration. So 80% of 2000 and 20% of 2000. So 80% of 2000 is 1600. This one goes to the parent. And the 20% of 2000 is 400. So that one goes to the NCI. So you subtract from purchase consideration, you get 150, you get 50. So this is goodwill. So to get total goodwill, you have to add. So total goodwill. So total goodwill will be 200. It will be 200. So that is for the use of full method. And on the scenario whereby you are not given directly the fair value of the NCI, but you are provided with the market price of the ordinary shares of the subsidiary on the acquisition date. So you have seen on how to get the fair value of the non-controlling interest. Then you go ahead to compute for the goodwill. So once we have covered that concept of being provided with the market price of the ordinary shares of the subsidiary on the acquisition date, and we have done an illustration of the same. So we can move on to another thing. So now the presentation of goodwill itself. So this is something you know, that goodwill is an intangible asset, but goodwill is obviously subjected to impairment. So it's like a tangible asset. Tangible assets, you depreciate it, then you state it under the statement of financial position as an asset. So presentation of goodwill, remember that according to IFRS 3, so positive goodwill should be capitalized and subjected to annual impairment review. The same way I've just said. So the net goodwill after that is impairment should be reflected in the statement of financial position as a non-current asset. You know that. But now, what about negative goodwill? Should not be credited. That should be credited, not should not be credited. Should be credited as income. Negative goodwill is treated as income. Negative goodwill is treated as income. That is as part of other incomes. So negative goodwill is never subjected to impairment. You never impair negative goodwill. Never impair negative goodwill. And you have known that negative goodwill is an income. Negative goodwill is an income. So measuring the cost of investment or purchase consideration. So when you measure the cost of investment or purchase consideration, refers to the amount paid to acquire the ordinary shares in the investee company. It refers to the amount paid to acquire the ordinary shares of the investee company. Remember that we have been talking about this. Even the illustrations we have been doing. You have been seeing that when they say that A acquired B, he acquired B by paying a certain amount, 4 shillings. So refers to the amount. So the cost of investment or purchase consideration refers to the amount paid to acquire the ordinary shares in the investee company. So it can consist, the fair value of assets transferred by the acquirer at acquisition date, liability incurred by the acquirer on behalf of the acquiring companies, equity instruments, e.g. shares issued by the acquirer in the exchange for control over the acquiring company. So purchase consideration can consist of fair value of the assets transferred by the acquirer at acquisition date. So it can consist of fair value of the assets. It can consist of liability incurred by the acquirer on behalf of the acquiree. Or it can consist of equity instruments, e.g. shares issued by the acquirer in exchange for control over the acquiring company. So the settlement of the above purchase consideration may be made in future periods. Remember that if you purchase a subsidiary today, if you acquire a subsidiary today, let's say you are supposed to pay 200 million. You say that I will pay you 180 million so that I check on the performance of your entity. Then I will clear the 20 million on a later date. So that is all about consideration which is paid in the future. It's a deferred consideration. So purchase consideration payable in the future are not deferred consideration. So everything was never paid now when the purchase was taking place. You have deferred some 20 million to be paid in the future. So which means that when you will be determining your purchase consideration, you have to discount that deferred consideration to the present. You know the discounting concept? The discounting concept from your financial management. Time value of money. Time value of money. So we have talked about deferred consideration. So deferred consideration arises when parent company is not capable to settle the whole amount of purchase consideration on the date of acquisition. So the part of the purchase consideration payable in the future should be recognized in the books immediately, but after taking into consideration their present values on the acquisition date. This is something I have explained, the discounting. So the difference between deferred consideration at the acquisition date and the date of payment is treated as interest. So the difference between the deferred consideration at acquisition date and the date of payment is called interest expense in the books of the parent. In the books of the parent. In the books of the parent. So sometimes the deferred consideration may depend on future events. Like now I say the parent should agree to pay an additional amount if the profits of the investee company exceeds a certain level within a particular period after acquisition. In short, this is what I explained in one sentence, that when you purchase a subsidiary today or an investee company today, then the total amount you never pay now, you paid in some amount in the future. In the determination of the purchase consideration, we have to discount the future payment to the present. So the difference between the two, the amount which you were supposed to pay as acquisition and the date of payment is an interest expense in the books of the parent. So they continue saying that as per IFRS 3, contingent considerations must be recognized in their fair value, at the acquisition date, even if it's not probable that the consideration will actually have to be paid. So for your understanding of these deferred considerations, let us look at this illustration here. So they were saying that P Limited acquired 80% of the ordinary shares of S on 1st January 2015. When the fair value of the net assets, of S was 90 million. P paid 30 in cash. P paid 30 in cash immediately, and they issued 1 million new ordinary shares to settle the purchase consideration. So he paid that million in cash. Then he issued 1 million new ordinary shares to settle the purchase consideration. The market price of P and S on the market price of P and S on 1st January 2015 or 13. This is 2015. Was 40 and 25. Additionally, P Limited agreed to pay this amount in 2018. But remember here, P had acquired 80% of the ordinary shares of S on 1st January 2015. So in that 2015, he paid 30 million. P paid 30 million in cash immediately and issued 1 million ordinary shares to settle the purchase consideration. So the market price of P and S ordinary shares on 1st January 2015 was 40 and 25. Additionally, P agreed to pay 14,641,000. That is 14,641,000 on 2018. That is after around 3 years. Because 2015, 2016, 2017, 2018, those are 4 years. After 4 years, he agreed to pay 14,641,000. So this is the amount which is deferred, the 14. It is never paid as at 2015 when the acquisition took place. Instead of paying everything in 1st January 2015, he agreed that he would pay an additional 14,641,000 coming 31st December 2018. P Limited cost of capital is 10% per annum. The fair value of the non-controlling interest at the acquisition date was 20 million. The fair value of the non-controlling interest. So which means that when I will be using a full method, it will be okay because we are given the fair value of non-controlling interest. You are provided with that. So when you are doing your goodwill, use the full method. So using the appropriate method, compute the value of goodwill. Using the appropriate method, compute the value of goodwill. So for us to compute the value of goodwill, we know some data, we know some information which has been provided there. And now since this is all about the concept I was covering concerning deferred payment, that is a deferred consideration, we can be able to say that goodwill, you know that goodwill is equals to purchase consideration minus share of net assets. Share of net assets acquired. So the share of net assets acquired. So on that scenario, remember that in this illustration, the purchase consideration was never paid at once. That is, it was never paid. The total amount was never paid as at acquisition date. So the first thing they paid in terms of cash, 30 million. Then shares were issued. So the value of the shares, value of ordinary shares, value of the ordinary shares. So there was 1 million ordinary shares which were issued. But now price per share was, remember that ordinary shares you were given were in terms of number of ordinary shares. So they said that P Limited paid 30 million in cash immediately and issued 1 million new ordinary shares. Who was issuing? The parent is the one which is paying the purchase consideration. So the market price of the shares of P. So the market price of P and S Limited ordinary shares on 1st January 2015 was 40 shillings and 25. So here I will use 40 because the parent is the one which is paying the consideration. So the parent is the one which issued the number of ordinary shares. So I would take 1 million times 40. So I get the value which is 40. Then after that, there was a deferred consideration. There was a deferred consideration, an amount which was paid in the future. An amount which was paid in the future. The 14,641. 14,641. So I said that amount was supposed to be discounted so that we know the value of that amount currently in 2015. So remember that this amount will be paid in 2018. But what is the value of this amount in the current year as at the date of acquisition? So we discount. So the discounting formula is 1 plus R. 1 plus R raised to power N. So 1 is just a constant plus interest, and you raise it to the time. So you say 1 plus 14,641. So the number of years are 4. Because now from 2015, 1st January 2015, the payment of this 14,641 will be made on 31st December 2018. From the time of acquisition, that is 1st January 2015 to 31st December 2018, those are 4 years. So if you discount, I would say, sorry for this. So there's a mistake I've done here. There's no way I can say it. It's 1 plus. So remember that here we have amount. So 1 plus the interest is, so that amount is what I will multiply with later. So the interest, what we provided with the interest. Yes, the interest. P limited cost of capital is 10%. P limited cost of capital is 10%. So this one is supposed to be 0.1. You raise it to power 4. Then once we get this answer is what we multiply with the amount, 14,641. So 14,641. So 1 plus 0.1, you raise it to -4, 10 times 14,641. So I'm getting 10 million. So I will just say here 10. I will say 10. So 1 plus R. R is the interest. It's not the amount. So I did a mistake here, which I have corrected. So 1 plus R, you raise to power N. You multiply here with the amount. So the amount which they were supposed to pay is there. 14,641,000. That is 14,641,000. You multiply with 1 plus the interest. The cost of capital you were given, 0.1, 10% that is. Then the period you consider from that time of acquisition and the amount that it was paid on which date. So you get the period. So that is, we have arrived at 10. So this is 80, the total. So which means that the total purchase consideration is that 80, including cash in terms of shares and a deferred consideration. A deferred consideration. So the difference between the 10 million and 14 million is what we call interest in the books of the parent. For now, we don't consider that. We wanted just to determine the purchase consideration when there's that aspect of deferred payment. So from there, we can determine goodwill. And since it's a full method, because already you were provided with the fair value of the non-controlling interest. So purchase consideration would be 80 in terms of millions. Then we have the fair value of NCI. So the fair value of the NCI, which was provided in this question, the fair value of the NCI, which was provided in this question, it's here. So the fair value is here. The fair value of the non-controlling interest as at the acquisition date was 20. So it was 20. So you raise the net assets. So share of net assets, share of net assets. So the block figure of net assets given, you were told at the start of the question that B Limited acquired 80% of the ordinary shares of S on 1st January 2015, when the fair value of the net assets, remember that never confuse yourself, never be challenged by this statement. Because some students, when they see this, they think that this is the information to use for you to use a full method. For you to do full method, you must be given the fair value of NCI, not net assets. You know, net assets is the equity component. And those are the ones we will use now here in the computation of goodwill. But this statement doesn't assist us that we know if it's full method or a partial. For you to know that it's full method or a partial, you must be given the fair value of non-controlling interest. So never be challenged by this, the fair value of net assets. Net assets, you know what's net assets. So that is what I will be using here next, the net assets. So 80% by 90 and the 20% by 90. So 80% of 90 goes to the parent, which is 72. Then this one is 18. 20%. So you deduct 80 minus 72. 8, then this is 2. So that is goodwill. So total goodwill here is 10 million. The total goodwill is 10 million. So after we are done with the concept of a deferred payment, and this one, it has been there, even in the financial reporting section 3. Like now in the last sitting, it was there, both for financial reporting and both for advanced. Then now we talk about preparations of consolidated statements of financial position. So the preparation of the consolidated statement of financial position. So we have various adjustments which you need to know, which are supposed to be made when you are preparing your statement of preparations of the consolidated statement of financial position. So when preparing the consolidated statement of financial position, items of assets, liabilities, equity of the parent and its subsidiary are to be combined on a line by line basis. On a line by line basis. What they mean is this. Remember that in your exam, if it's an income statement, remember that, for example, A acquired B, he acquired C and D. So let's say now this is revenue. So revenue will be given 200, 100, let's say 50, 50. This is an example. Cost of sales, the same. Cost of the sales, the same. 200, let's say 50, 20, 20. So that is why they are saying that the same even in the statement of financial position, you will be given statements of these entities which are acquired. So you have to add them on a line by line. Like now, if it's revenue, let me say that A and B are the group members. I mean, A is the parent, B is the subsidiary, C is the associate, and D is the joint venture. When we do consolidation, we always take the parent plus the subsidiary. We never add these associates or joint ventures because they are not group members. They are not the group members. The parent doesn't control them. The parent will account for them later using either equity method. That is so, or we can consider some few items which I would come specific when we do a question. What are you supposed to consider in associates or joint ventures? But most of the things we always add on a line by line basis is those of the parent and the subsidiary. So we add on a line by line basis. Then we make adjustments. So that's what they are saying here is that when preparing the consolidated statement of financial position, assets, liabilities, equity of the parent and the subsidiary. Parent and the subsidiary. Because the parent and the subsidiary are group members. The parent controls the subsidiary. He has a shareholding of more than 51, are to be combined on a line-by-line basis. However, cost of investment in the subsidiary, cost of investment in the subsidiary, cost of investment in the subsidiary should be reflected, should not be reflected. It's not supposed to be reflected. Should not be reflected in the consolidated statement of financial, in the consolidated statement of financial position. Rather, replaced by goodwill. You replace it by the goodwill. So this is what I'm saying here. Let me just display one of the questions and give an example. So to make specific, this adding line by line basis of the statement of financial position. Right now, check here. This was H, which acquired S and A. These are a sitting question. So what they mean is this: when you are doing your consolidation, the items of assets, the items of equity, the items of liabilities, you add them on a line by line basis. But like now, the cost of investment, this investment which is here, you can see under non-current assets, there's an investment there. This investment, you don't record it. You replace it. So remember that this investment, it's under the parent, which means that the parent is the one which made investments in S and A. The parent is the one which made investment in S and A. So the investment in S is replaced by goodwill. And the investment in A, you say, maybe this is an associate or joint venture. You say the investment in A, but using the equity method. So for the others, other than this investment, so the investment in subsidiary is replaced by goodwill. Then the investment in associate or joint venture, you just account for the associate or joint venture using the equity method. You record the investment in associate or joint venture. So for the others, you just add on a line by line basis. Then for the equity part here, like now ordinary share capital and share premium, you use only for the parent. You pick this figure of the parent. That is what you record. You use the figures for the parent. Because those of other investee companies, those of the investee companies will be used in the computation of goodwill. So he said that, however, cost of investment in the subsidiary should not be reflected in the consolidated statement of financial position, rather replaced by the value of goodwill. That is what I was talked about with a short interpretation from the receipt in question. So ordinary share premium and reserves of the subsidiary company should not appear in the consolidated statement of financial position. That is, only the equity of the parent should be reflected. That is what I have said again. That is what I've talked about. So other than knowing how to record those items, other than knowing that, let's talk about the adjustments which are supposed to be made. The adjustments which are supposed to be made. Like now we have intercompany balances. Intercompany balances. So this one can be interpreted in a simpler way. So simpler way, I mean this. When we talk about intercompany balances, or they call it intercompany owings or outstanding balances, one company owes another entity. The parent owes a subsidiary. The student owes the teacher, or the teacher owes the student. So when this, let's see now from that perspective, the teacher is the parent, the student is the subsidiary. When they owe each other this amount and the amount you have not paid by the end of the year, by the end of semester, you have not paid the amount. Let's say now it was between the parent and the subsidiary. The parent owes the subsidiary and the amount was not paid by the end of the year. This amount is not supposed to be carried forward to the next financial year. So what happens when there's an intergroup owings? Intergroup, parent between subsidiaries. So that is parent and subsidiaries. Intergroup owings or outstanding balances. So if this amount has not been paid by the end of the year, one that is subsidiary has not paid, maybe it was the subsidiary who was supposed to pay. And if the parent who was supposed to pay has not paid by the end of the year, we forgo the amount. Because at last, the parent will consolidate the operations of the subsidiaries and present consolidated financial statements. So there will be no impact when we forgo the amount. So how do we forgo the amount which was outstanding, which had not been paid? We debit and we credit a certain account. So when you forgo an amount which has not been paid, by the end of the year, you debit group payables account, then you credit group receivable account. So let's say that it was A and B. So A owes B 100. So this amount you forgot that way. But now what if A had paid? A had paid 20, but it has not been received. It has not been received. It has not been received. A had paid 20, but it has not been received by B by the end of the year. So which means that this 20, the 20 was on transit. The 20 was on transit. So on this scenario now, remember the total amount which was being outstanding from A to B was 100, but A had paid 20. So for now, the correct owings is 80 because 20 has been paid. 20 is paid. It's only that it's on transit. So what you do, you forgo the 80 the same way here. You forgo the 80. You debit group payables, you credit group receivables. Then the 20 now, which had been paid, remember that you need to reduce your group debtors balances, that is receivable. The group receivable account, you credit. Then this one is credited. You debit. What is debited is a cash or a bank balance. The cash or bank balance. That is how you deal with the cash in transit and the intergroup owings, receivables. So that is concerning intergroup owings and cash in transit. So that is what they have said there. Refers to the amount which the group members owe each other at the end of the financial period. When preparing consolidated financial statements, the intercompany balances should be eliminated in full. So the elimination should be done by adjusting group receivables and group payable. So we have done that. So we have said that we debit group payables and we credit group receivable with the amount which was outstanding, which had not been paid by the end of the year. However, there is a circumstance whereby the two accounts may fail to be in agreement. That is, the intercompany balances between the parent and the subsidiary may differ. So this variation may be due to cash in transit. So we might have goods in transit and errors in the accounts. So I've talked about cash in transit, whereby one entity which was supposed to pay a certain amount, it had paid, but the amount has not been received on the other end. So we have to adjust our books because the amount obviously it will be received even if it's on a later date. So that is why they say that arises when one entity in the company, that is in the group, has remitted some money to the other group member, which had not received at the end of the financial period. So when we make adjustment on cash in transit, we debit cash, we credit group receivables, because now it will be received in terms of cash or in the bank. Then since that amount had been paid, it's only that it has not been received on the other end. Remember that we have to reduce our group receivables. Then we have goods in transit. So as per S2, remember that we measure inventory as per International Accounting Standards 2. We measure inventory at the lower of cost and net realizable value. That is according to International Accounting Standards 2. We measure inventory at the lower of cost and the net realizable value. So as per S2, inventory should be valued at the lower of cost and the net realizable value. So you will find that if there was goods in transit, let's say A had sent some goods to B, as sold. The parent had sold some goods to subsidiary. These goods, he sold them at credit. He sold them at a credit to B. But by the end of the year, the goods were never received here. They were received after 3 days. They were received after 3 days. That is why we always say that they were on transit by the end of the year. So when we record this to our statement of financial position, even if after 3 days, remember that what you call after balance sheet events. So you have to adjust your balance sheet, even if they will be received after 3 days. They are material transactions. So, and they were on credit, you remember that. So they were on transit. So once they will be received, after that 3 days of closing our financial statement, remember that we need to adjust again our balance sheet by debiting inventory. By debiting our inventory, then we credit, because now once they will be received under stock. Then now since they were on credit, our group payables must be increased. That is group payables. Group payables accounts must be increased because they were on credit. They were on credit. That is the case. So that is what they have said there. Group goods in transit is adjusted at the lower of cost and the net realizable value in the books of the entity, which was supposed to receive such stock. Debit to group inventory, credit, group payable. You have understood what I've explained. So errors, you correct them where they occurred. You just correct them. Then we have another adjustment here. We have another illustration here. UPS, and realize the profit on stock. UPS. So UPS and realize the profit on stock. So this arises whereby you will find that one entity has sold goods to the other at a profit. But now that other entity which received the goods never resold all of them. So remember that the one which sold these goods to the other entity had recognized the profit when he was selling. But now the other entity which will receive, we have said that it will never sell everything. So if it has not sold everything, so let's say if it's A who sold goods to B, A is the parent and B is the subsidiary. I'm using the examples of parent and subsidiary because those are group members. So let's say A sold goods to B worth 100 at a profit margin. So they would say that a profit margin of 20%. So A sold goods to B at a selling price of 100. At a selling price of 100. A included a profit margin of 20%. But at the end of the year, B resold only a half. Resold only, let's say resold only a half. So remember that a half is unsold in B. But when B was buying these goods from A, he paid A the total amount. So which means that under B, there's an unrealized profit on stock. He never sold everything for it to realize the profit which A realized. So which means that for you to compute this UPS, you take the unsold goods, times profit margin. You take the unsold goods times the profit margin. So unsold goods in B, a half, which is 50. It's 50 because the selling price is 100. So you take 100 times the unsold goods, which is a half. So you take the unsold goods times profit margin. Profit margin is 20%, so that is a fifth. So the unrealized profit is 10. The unrealized profit is 10. So when you are adjusting this 10 in your books, it will depend on sales stream. It will depend with sales stream. So if it's A who sold to B, that is a downstream sale. A is the parent, B is the subsidiary. A is the parent, B is the subsidiary. So what you do in the adjustment on that scenario is, so let's say that what you do here is, let's say it's a downstream sale. So remember now I need to adjust this unrealized profit on stock. So by doing what? By adjusting to accounts. I have to adjust my retained earnings, which I have to debit retained earnings. Then I have to credit the inventory. Because remember that this profit was realized by A. The 10 was already realized by A. It was only that it was never realized by B, because B never resold all the goods by the end of the year, which it received from A. So A sold to B, but B never resold all the goods received from A. So we have computed UPS and realized profit on stock. So which means that for you to make the adjustment due to a downstream sale from the parent to the subsidiary, we need to adjust the profit of A, because the profit of A is overstated by what the parent never, by what the, not the parent, by what the subsidiary B never realized. A had realized everything, but B never realized everything on those goods because he never resold all the goods. So for you to correct the profit overstatement in A, that is why I am debiting group retained earnings, then I credit inventory. What if it was an upstream sale? What if it was an upstream sale? Let's say it was now the subsidiary, which was selling to the parent. Subsidiary selling to the parent. So under the subsidiary, remember that the subsidiary is never controlled fully. So which means that there is an aspect of NCI, and that is what will be introduced here. So you debit your retained earnings. You debit your retained earnings with the percentage of the parent, with the percentage of the holding company, not NCI, with the percentage of the holding company. You debit your NCI, you debit your NCI account with the percentage of NCI, then you credit inventory. You credit your inventory account with the total amount, with the total UPS. So that is the case when it's an upstream sale. UPS, you have understood what it means and how you compute. Unsold goods times profit margin. The unsold goods are the goods which were unsold by the other entity which received them. But the one who was selling had realized the profit, but the one who now was the buyer never resold all of them. So since he never resold all of them, you need to determine the profit he never realized. Then after that, you make your adjustment to the books. You make your adjustment to the books of accounts. So that is UPS. We have read a lot of stories there. That is UPS. All the examples I've given have been provided there. Then we have something called UPFA, unrealized profit on fixed asset. Again, I can just simplify that. So another adjustment is concerning UPFA, unrealized profit on fixed asset. So the unrealized profit on fixed asset, this one arises when there's a sale of fixed asset. Intergroup sales of fixed asset. This is supposed to be just a transfer, not even a sale. It's supposed to be a transfer at profit. Transfer at profit. So, but now the other entity, if it's A, who transferred the fixed asset to B. Let's say A transferred a fixed asset to B at shillings 240 million. So when there's this transfer of fixed assets from one entity to the other entity which will receive this fixed asset, the fixed asset will never be resold. Will never be resold. Fixed assets are not meant for resale. So even if this A sold to B, let's say at 20% on cost, at 20% on cost, at 20% on cost. So you will never be told that B resold. They will just go silent. They will say, for example, A transferred a fixed asset to B at a selling price of 240, making a profit of 20% on cost. Then they will say that depreciation, intergroup depreciation rate. Depreciation rate is at 20%, 20%. So what you are supposed to compute here is unrealized profit on fixed asset, because they will never say that B resold or the recipient of this asset resold the asset. He will never resell it. So which means that he will never realize the profit. Profit will not be realized by B, but A had realized that profit. So to determine this unrealized profit on fixed asset, you take the value at which the asset was transferred, transfer value times profit margin. Transfer value times profit margin. So the transfer value times the profit margin. So the value at which the asset was transferred is 240. What about profit margin? So this one, they never provided profit margin direct. They said at 20% on cost. Because I said they will say A sold a fixed asset to B for shillings 240 at a 20% on cost. So when they say on cost, they mean this one is a markup. That is a markup. When they say on cost, on cost, that is not a margin, but a markup, a profit markup which was included. So, but we know that we need to get margin. So if markup is 20%, which means that that is 1/5. What about margin? So margin, to get margin, you say 1/5 plus 1. You add the numerator to the denominator. You add the numerator to the denominator. You get 1/6. That is what I multiply here to get 40. Then I said they will go ahead and say the intergroup depreciation. But now before we go to that intergroup depreciation, you have understood what is UPFA is. UPFA, unrealized profit on stock, is the profit which will never be realized by the entity which received the fixed asset. Fixed asset, because this fixed asset will never be resold by that entity. Like now, A sold a fixed asset to B at a profit of 20%. So which means that B will never resell it. As I have said, fixed asset is never meant for resale, which means that B will never realize the profit. That is what we are computing here. And realize profit on fixed asset by taking the transfer value times profit margin. You determine that. So since B will never realize the profit, but A had realized, which means that A's profit is overstated. Profit of A is overstated. Remember, these are group members. A and B are group members. So the profit of A is overstated by this 40, which B never realized. Which B never realized. Because B never resold the assets. He received from A a profit. We need to correct this profit overstatement. We need to correct that. So when you correct a profit overstatement, you debit retained earnings. You debit your retained earnings. You credit your PPE. Remember that this is a fixed asset which was sold. You credit your PPE account. Then after that, due to the sale of fixed asset, due to sale of fixed asset, due to the sale of fixed asset, due to the sale of fixed asset, what arises is what we call depreciation overcharge. Depreciation overcharge will arise because they will say the group entities charged the depreciation. So both of them, in short, when A was selling the asset to B, when A was selling this fixed asset to B, A charged the depreciation. When B will receive, we will charge depreciation. They are group members. They are group members. Both of them, they have subjected the assets to depreciation, which means that they have overstated depreciation. They have overcharged the depreciation on the asset. So for us to compute that, we always say that depreciation overcharge is equals to UPFA. UPFA terms, depreciation rate. For example, in our example, UPFA is 40. Depreciation, I said, is 20%. So you take your 20%, you get your 8. So since there is a depreciation overcharge, it means that they have understated the value of the asset. They have understated the value of the asset. They have understated the value of the asset. At the same time, they have understated the profit because there is an overcharge. There is an expense which is overstated. To correct that overcharge, remember that we have to debit PPE account. We debit the PPE account. We credit the retained earnings with the depreciation overcharge. We credit the retained earnings. We credit the retained earnings. That is all about UPFA. That is all about UPFA. And here is the profit on fixed assets and depreciation overcharge. And the depreciation overcharge. I think if you can allow me, I do 10 minutes. I finish the two things which are here. Then we start from there next time. So we finish at 9:15. So another thing I would like to explain is concerning revaluation. I would just simplify the revaluation. That is another adjustment which is supposed to be done, which is concerning revaluation. So revaluation, when you hear the word revaluation, revaluation is the difference between the fair value or the market value of an asset, the fair value or the market value of an asset, and its book value. So the difference between the fair value and the book value. That is what we call revaluation. As they have said in these notes, as they have said in these notes. And I think you have these notes. These notes are very important. You see, this is what I'm using. So revaluation is the difference between the fair value of an asset and its carrying amount. So carrying amount, it's all about net book value. So remember that once there is revaluation, you will find that an asset has increased by a certain amount. So revaluation. So that is why they are debiting PPE. Then you credit revaluation. You credit revaluation. So you debit PPE, you credit revaluation. So since there is revaluation, remember that revaluation gain, that figure, we have said that figure between the book value, or we call it the carrying amount, and the fair value. The difference between the two. So the revaluation, so the asset has increased with a certain figure here. So this figure of revaluation has not been subjected to depreciation, because when we were doing depreciation, we used the book value. We used the book value, but the asset has increased by a certain figure. There's a figure which this asset has increased with. So which means that when we were doing our depreciation, we did a depreciation undercharge. So due to revaluation, it leads to depreciation undercharge. So we need to know which is the depreciation which is under this figure of revaluation. So for you to do that, you have to take your revaluation gain times depreciation rate. Or you take your revaluation gain, you divide with the useful life. You divide the useful life. And now, since it was a depreciation undercharge, again, you need to make your relevant adjustment in the books, because a depreciation undercharge, it means that your profit was overstated. So with a depreciation undercharge, you debit your retained earnings, then you credit your PPE. Because obviously, if you are undercharged depreciation, even the value of the asset was more. So when you credit, you subtract. When you debit here, you subtract. Because if you understate your expense, what do you expect your profit to be? Suppose it would be overstated. The same, the asset would be overvalued, it would be overstated. So to correct that, now you deduct under retained earnings, and you deduct under the PPE. You deduct under PPE. So the last thing is all about dividends paid by a subsidiary company, which was acquired during the financial year. So remember that for this to be applicable, dividends, the subsidiary must have been acquired during the year. So if the subsidiary paid dividends during the year, not during the year, yes, it paid dividends during the year, but again, it must have been acquired during the year. Our financial year runs from January to December 2021. Our financial year runs from January to December. A acquired B at the middle of the year, or let's say at 1st October 2021. Then B paid a dividend of a certain amount. So I say for dividends to be applicable, to be used, the subsidiary must have been acquired during the year, so that we have a pre-acquisition period and we have a post-acquisition period. So dividends for their pre-acquisition period, the dividends in their pre-acquisition period, this one will be credited in the cost of control account when you are computing for your goodwill. But the one for the post-acquisition period, dividends, they will be credited under the retained earnings account, as income. They will be credited in the retained earnings account as income. So let's go through the statement so that you understand a bit on these notes they have provided here. So they have said that dividends paid by the subsidiary company, which was acquired during the financial year, The main concern is on how to account for pre-acquisition dividends attributable to subsidiary before acquisition and the post-acquisition dividends. Pre-acquisition dividends is taken into consideration for determining goodwill. So which means that in short, their pre-acquisition dividends will be part of the net assets when you are doing your goodwill. In short, that is the case. Then post-acquisition dividends are to be credited in the group retained earnings as income. As an example, which is given here, whereby they say H acquired S on 1st October 2017. The two companies prepare their financial statements on 31st December. S Limited paid first and final. S Limited paid first and final dividends. S Limited paid first and final dividends on 31st December 2017. On 31st December 2017 of shillings 320. So you can see that H acquired S on 1st October 2017. 1st October 2017. But the two companies prepare their financial statements on 31st December. That is why here, our financial year was ending 31st December. It's starting on January. Then S was acquired on 1st October. S was acquired on 1st October. So which means that we have a pre-acquisition period of 9 months and we have the post-acquisition period of 3 months. Then they said that on 31st December, so he paid a first and final dividend of 320. So by the end of the year here, he paid a dividend of 320. So we have to apportion these dividends for the first 9 months and for the last 3 months. So for the first 9 months, this one, pre-acquisition dividends, these, 192. They were supposed to be used as part of net assets when you are doing your goodwill. This one would be part of net assets when you are doing goodwill, because you say 80% times 320 times 9 over 12. Then the other 3 months, this one will be credited in the retained earnings account. They will be credited in the retained earnings account. So that is the end of the class for today. That is the end of the introduction. That is the end of the introduction of group accounting. So when we meet next time, that is on a Tuesday, we will be able to start doing now questions for with 2011. I will start with this question of 2011, June 2011, whereby the parent has acquired a subsidiary and a sub-subsidiary. I think it was a perfect introduction. You have understood what is supposed to be done, what is supposed to be covered, what are the adjustments you are supposed to know. When at least I would be doing questions. So you will never be blank when I will be doing questions. So I think if there's no another question from your end, we can say that you have a nice weekend and a week ahead. We meet next time.
I have a request.
So guys, you have seen this is all about, this was a live session. This is a live session class which we were doing. So remember that now you are remaining with just 1 month to your exam, but this 1 month is a lot of time. You can make a bigger impact to your pass, which you would be expecting when you do your exams coming December. So never hesitate to call my number. That is 0728 760 546. If you could like to join these classes, which are ongoing, then after this end of the syllabus, which I'm still covering, we will be able to do a short crash revision. That is on a group accounting, that is EPS, that is earnings per share, reconstruction, and the preparation of cash flow statements. You are free to share this video to your friends, the one who are doing anything concerning this financial reporting aspect, so that at least we can reach the targets and we can be able to be socially responsible to the community. So have a nice weekend. Today's this session was on a Sunday, so we say it's a Sunday. So whoever will be attending church, all the best. So let us meet on our next session when I will be doing another live class. That is on Tuesday, because our classes are on Tuesday. So whoever would like to join, our classes are on Tuesday, 8 p.m. to 10 p.m. The same with so this is Tuesday and Wednesday. Then we have the one on Sunday, the early morning, the one from 6:30 to 9. So this is for advanced financial reporting. Even for other units, financial reporting also, if you would like to join, you can be able to contact me. The same with company law, QA. So every unit in a CPA, because for company law, I have a nice lecturer who is a lawyer, who is supposed to cover the same. So once you come in, you are doing company law, I will just link up with the guy. He's a lawyer, so he understands what is supposed to be done in company law. Even business law. QA, there's another guy called CPA Mutiso. MA. So there's no paper we cannot cover in CPA. So just contact me through the number I have provided. If you have any issue in accounting, in CPA, prepare early enough before time catches you. So let's meet next time. Have a good day and remember to subscribe. Never just watch and move out. Press that subscription button and open the notification bell so that once I upload another video next time, you will be able to be notified. You can be able to be notified. So have a nice weekend.